2002, Rakesh Jhunjhunwala saw a turning point in our stock market. He wrote his thesis in an article in Economic Times, and it is around this period that he went and bought his iconic stocks that later on made his fortune: Crisil, Lupin, and of course Titan. So what were these signs that he saw, and do they hold good today? So the first sign that he saw was that there was a 10-year bear market that preceded 2002. From 92 to 2002, the Sensex went nowhere. If you recall, 92 was the peak of the Harshad Mehta bull market, and since then the stock market went nowhere. So he saw that as the first positive sign. The second sign that Jhunjhunwala spotted was the price to earnings, or PE ratio. The PE ratio of the market in 2002 was just 12. Does that hold good today? Here I would say no. Our current PE ratio for the index is 25. It is by no means cheap. The third sign that Rakesh Jhunjhunwala saw was the economic reforms momentum. He said that there had been reforms done in banking and telecom, and he was hopeful of further reforms in other sectors. That has indeed unfolded. Now the question is, does that story hold good today? There is every reason to believe that the reforms momentum will continue. It has been quite robust in the past 5 to 10 years, and there is almost a political consensus behind economic reforms. The next sign that Jhunjhunwala saw was about earnings growth. So he felt that earnings growth was quite strong in 2002 and will get stronger in the next few years. What unfolded, of course, was the first boom period that immediately followed, 2002 to 2007. Is that true today? So if you look at this mid and small cap space, earnings growth indeed has been quite strong, and that has supported the rally in that space. And will that continue? Again, there is every reason for it to indeed continue. There are no dark signs yet. The next sign that Jhunjhunwala saw was about the money flowing into the stock market. He said that at the time in 2002, the size of the entire Indian mutual fund industry was just 2,000 crores. Today that size is 50 lakh crores. Now again, will that continue going forward? If you look at how much Indian households allocate to mutual funds, it's just 8% of their balance sheet. So there is every chance that this momentum continues to grow. The next sign that Jhunjhunwala saw was of market structure and that changing. So if you think of the market in 2002, it still had the legacy of the 1990s, of physical share trading, of slow settlement, of signature mismatches, issues like that. Those got fixed over the next 10 years. Now the question is, in today's market, is there more scope for this to run? Arguably there is. Although settlement has gone from 10 days, 14 days, all the way to instantaneous settlement that SEBI is now trying out, there are areas like KYC that can see further reforms and further money coming into the market. The last sign that Jhunjhunwala saw was of market momentum. He saw that every dip was getting bought and there was inherent strength in the market. Is that true today? Again, if you look at all the dips and corrections that have happened in the past 2 to 3 years, they have rapidly are being bought. Even if you think of the COVID-19 correction, that too was cancelled out in the matter of a few months. So there is an inherent strength to our market, and that factor also holds good today.